Hi, this is Dan Danford. We're doing another episode of Money Made Easy for dadsdivorce.com. We have another great question from the website. My wife and I are looking to refinance. Both of our names are on the deed to the house, but only my name is on the mortgage. So would both of us have to supply financial information, or will only mine be required? Hey, that's a great question. One of the things we see today is there's a lot of refinancing things going on in the marketplace. I mean, it's a good opportunity. Rates are low, so there's just a lot of activity as people try to refinance. One of the issues that you have to understand, you have to kind of look at the transaction from the bank's standpoint to understand the answer here. Bottom line is, one of the unique things about a mortgage loan is that the bank takes your house as collateral on the loan. So in other words, if you default on the loan, they basically take over your house, they sell your house, they pay off the loan. If there's anything left over, then you get it. Okay, that's how it works. That's a foreclosure. In legal matters, having a home titled to two spouses, husband and wife, creates a problem for the bank, okay? Because even though the mortgage is in your own name, if they would have to foreclose, they could foreclose, and they can even get a judgment against you. But without the spouse's consent, they can't really do anything with the property, okay? So what you have to understand is they are going to want the titling of the property and everything related to it in a manner that they can foreclose on it if they need to. So their preference is going to be to have both of you on the mortgage and both of you on the property. That way, if you both default, then they can foreclose and get the house and get everything sold the way they want to. Okay? It's just an issue of how they can get at those assets. So, you really don't have a lot of flexibility here. The truth of the matter is, if you're going to borrow money from them, they are going to demand certain things in advance. And, there's a whole list of things that they require as part of the mortgage package. But foremost to them is they're going to require that that property be titled in a way that if you default on the mortgage, then they can take over the property. Now, the advantage to maybe having it in your own name as opposed to having it in both of your names, maybe with the mortgage, maybe you don't need both of you, you don't need the income from both of you to justify the amount of the loan. And that would be okay, and they would be glad to lend you the money that way, but they still need to have a way to lock up that collateral if they need to. So it's far more likely what they're going to want is they're going to want both of you on the mortgage and both of you on the deed. Okay? Or they're going to want one of you on the mortgage and the same one on the deed, but they aren't going to be crazy about you mixing and matching there. They're going to want it their way so that they can get the money if they need to. Of course, they also require an appraisal on the property. They also require title insurance on the property. They also require, they have a whole list of things. And, if you've bought or sold houses in the past, it's kind of like signing your life away, because you'll have an inch-tall stack of paper that you have to sign. The truth of the matter is, although there might be things that we would prefer to do in a different fashion, we really don't have a lot of negotiating power here. Most lenders are going to require the same things of anybody they loan money to, because basically they want to be able to get at that property. They want to be able to foreclose on the property and have clear title to it if they need to. So I would just work with your lender to arrive at the most favorable rates that you can, the most favorable terms that you can, but you have to understand that they're going to want certain things to protect themselves. It's just the nature of a long-term loan. These loans last for 15 or 30 years, so they just want to protect themselves in any circumstance. So I hope that's helpful. Drop us a line on the internet and let us know whether you got it done or not. We're interested in hearing how things work out. Best of luck to you. That's another episode of Money Made Easy for dadsdivorce.com. We'll see you again next week.